about to hear my conversation with Dustin Reed, our chief fixed income strategist. We talk all about the recent decisions out of the Bank of Canada and Fed to cut 25 basis points, what that might mean for the economy, and what it means for positioning within fixed income portfolios. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. My name is Matthew Schnurr, and I'm back with our chief fixed income strategist, Dustin Reed. Dustin, welcome back.
Hey, Matt. Great to be back with you.
I'm looking forward to your comments today. It's September 17th, a big day. We had both a Fed meeting and a Bank of Canada meeting. Let's start with the Fed, and I'd love to get your reaction to the 25 basis point rate cut.
For sure. So, indeed, the Fed did cut by 25, as was very widely expected going into the meeting. I think going in, we were about 27 basis points price. There were a few people looking for an outside surprise of maybe a 50 basis point cut, which did not happen. We got a September meeting, so we have a forecast update from the Fed. Fed's expecting another 50 basis points of cuts for the remainder of 2025. There are two meetings left for the year, one in October and one in December. And then I think only actually had one cut priced for 2026 when you look at the median versus the median. And of course, these things will bounce around a little bit.
Sure.
But so the Fed basically doesn't have a lot really priced in, really 75, or at least penciled in, I should say, 75 through the end of next year. And that there's a bit of a gap, and there's been a bit of a gap for a while between where the market is, market expectations, and the Fed. For example, the market would probably be closer to, again, it's been bouncing around a bit today, but call it 135 basis points ish through the end of 2026, with the Fed now around 75. So there's a bit of a gap there, and we can talk about the need for that to potentially close and how that might do that. The statement was relatively, I would say, dovish, and markets traded it as such. The big pivot really in the statement, and this is the first one since Jackson Hole, maybe no surprise, is this discussion around the labor market. And obviously at Jackson Hole, Powell made a strong pivot towards the labor market and a dovish labor market, or a labor market that's maybe not working at full capacity anymore. And then we obviously had the revisions as well as the non-farm payroll report for August and early September, which was also weak. And then we had the revisions, the annual revisions, at least the preliminary annual revisions for the 12 months through March, that saw a revision of 911,000 less jobs through the 12 months through March 2025. So it kind of reset the table of where I think a lot of people, including the Fed, thought the labor market is, and or at least where the labor market was, and maybe where it currently is, and helped, I think, spur a change in tone. So now, you see the Fed statement start, instead of talking about balance risks in the outlook, talking a little bit more about downside risk, particularly with respect to the labor market. And the Fed has clearly made the switch within the dual mandate, stable prices and max employment, towards the employment side of the mandate, and focusing a little bit less, although not taking its eye off the ball, on the inflation side. The press conference here today from the Fed was almost the opposite of what we got from a market reaction after the initial statement. And some people took the press conference to be relatively hawkish. So we saw a pretty significant round trip here. We're in the early hour or hours after the Fed meeting when we're recording this, but we saw a pretty significant round trip across asset classes, whether it's equities, whether it's currencies like the dollar and various dollar crosses, on the bond market side as well, fixed income side as well. There was a comment that Powell made as part of his Q&A in the press conference that effectively said that today's cut was a risk management exercise and an insurance cut. And around the time that Powell made those comments, the market turned from kind of the Goldilocks type price action to fading that around the comment that I just mentioned. And that's a very, very interesting comment to me. And of the handful of things that I mentioned kind of to the team in real time, I know as we were watching the press conference, that was the one that really did not sit well with me. This idea of a insurance cut or risk management, and that seems to suggest that the Fed, or at least some people at the Fed, don't necessarily think that the Fed needs to do a lot more cuts, and that also is at odds, which I'm having a little. It's interesting, kind of trying to square the circle. You're adding more. The Fed's adding more rate cuts in the short term here over the next 3 months through the end of 25. But at the same time, Powell in the press conference is suggesting that today's cut is an insurance cut. So those two things don't particularly line up. So just chatting with people, at various shops, kind of in real time, throughout the press conference. A lot of people not particularly sure what the message is that the Fed is trying to get across, and so I think this is a really a challenging Fed meeting to kind of pull apart and figure out what's going on. At the end of the day, I think we have a Fed that probably agrees that the labor market was weaker than it thought, and given updated data, it probably wants to recalibrate rates lower. Although Powell actually did not use the recalibration term that I heard anyway, which he has used in the past, but he did not use a recalibration during the press conference. But the Fed believes, I think, that rates need to be a little bit lower, a little bit closer to neutral than where they currently sit, and this modestly accommodative stance where rates were 4.25, 4.5 Fed funds range, and now 4%, 4.25, probably needs to be a little bit lower. But this is not a Fed that seems to be interested in getting to what I think is neutral in a hurry, and definitely not going what a lot of people would expect to be below neutral. And I think that's probably why we're seeing, at least initially, maybe not an extension of kind of this Goldilocks rally across asset classes here in the immediate aftermath.
Got it. And remind me, what's considered neutral?
Well, that's a great question. There are a few definitions, but nominal neutral, most people would suggest that it's probably around 3.5%. Um, but a lot of people also think, or at least people at the Fed, probably spend just as much time, if not more time, on what is the real neutral rate as opposed to the nominal neutral rate. So, the interest rate less inflation, and that is probably closer to 75 to 100 basis points, real neutral. And the debate, I think, around neutral is going to be a very key driver in terms of policy and therefore markets over the next, I would say, 1 to 3 quarters, and trying to figure out where that is. And has the Fed gone far enough? Has the Fed gone too far? Is the Fed making a policy error? Is the Fed not making a policy error? I think that is going to be on investors' minds here over the next number of months and quarters.
Great context on that. I'm curious on the forward-looking projections, both by the market as well as the forecast. I guess I'd love your thoughts on sort of Fed independence and tying in Fed independence and the like
Mhm.
into that. Obviously, there's been a lot of attacks from Trump. Bassett lately has also provided sort of intellectual rationale on what some people would call encroachment on Fed independence,
Mhm.
and Stephen Moran just being added to the board. And I'm curious on because Powell's term is up in May of next year, I believe.
That's correct.
What is the expectation from, I guess, either yourself or markets for the path of rates before and after that date?
So I think the Fed independence story is an important one, and it's something that you and I have talked about a lot on not only on this series of podcasts, but also on Get Sharp. We did that one in October of 2024 with Larry Hathaway, talking about kind of the nitty gritty around Fed independence. And I think we are clearly there. All right, we've been there for a while. The Moran addition to the board, was clearly felt today. He was confirmed on Monday by the Senate in a, I think, 48-47 relatively bipartisan vote. Very close. And so his first day on the job was the first day of the 2-day Fed meeting, and he dissented with today's decision, opting for a 50 basis point cut. And we don't know exactly whose dot, so to speak, is whose, but there's a mysterious dot that has shown up on the dot plot that was not there 3 months ago, and it's actually looking for sub 3% Fed funds rate by the end of this year. So that presumably is Steve Moran's preference and estimate. So that is clearly, having a slight impact. It has an impact on the median dot. Of
Sure.
course, it has an impact in terms of dissent. And it obviously shows where the administration wants rates. Maybe not a surprise, but maybe quantifying it a little bit more officially now. I don't expect Powell to kind of take the slightly different exit ramp in May. Powell probably has the ability to stick around using his governor appointment. I think that's very unlikely. I think he'll probably leave, and so we will have a new Fed governor, and who that new Fed governor will be will potentially accelerate Fed cuts. I mean, it depends on obviously where the data is, what the data is suggesting, and really what I would say the state of the play is from the staff and what the staff is recommending to the board. If the Fed is close to neutral at that point in time, and there's no need from a market's perspective for the Fed to continue to cut rates from a data perspective, then that's when we get into the concern around policy error and that policy error type trade. And if not, then that won't be the case. The Fed is a very large institution, like a large corporation, and changing culture and having influence in changing culture at a corporation obviously can happen. Of course, it can happen. Happens every week, every quarter, every year. But it is difficult to do so, and it doesn't change on a dime. And there are a lot of PhD economists that are quite rooted in their academia around the Fed system, whether that's at in DC or whether that's at the district, at one of the 12 or any of the 12 district banks. And so it takes a long time, I think, to change that culture. So even if you have a Fed chair, and in this particular case, I want to be specific, an FOMC chair, because it's the FOMC chair that does rates, not technically the Fed chair, although those are usually the same person. But if the chair of the FOMC is maybe suggesting something that is not in line with other governors and other district presidents that are voting during that current year, next year, 26, then it's obviously possible. We haven't seen it really before, but that chair could be outvoted. It's a voting system, and it takes votes to actually make this happen. So it's not a guarantee, but clearly the impact of the independent story will be a driver. And as is traditionally the case, many governors generally follow the chair and rarely dissent. Although we've seen a few dissents over the last few months, but typically you see governors voting with the chair. So I think we're on the cusp of seeing a lot of interesting stories. We've obviously seen a lot already, but more interesting stories around the Fed. In terms of accelerating, I mean, I think it really depends on how many Fed cuts the Fed does between now and May. And if the Fed does a bunch and gets closer to neutral, then I don't think the economy is going to warrant going below neutral. But of course, I could be wrong, and we'll see how that plays out. But if the economy does not warrant going below neutral, then in theory, whoever shows up in May may not have a ton to do. Um, and if they do something and it doesn't seem to be fundamentally warranted, that's when things can start getting a little bit challenging around dollar as a reserve currency. What does it mean for U.S. Treasuries? What does it mean for the equity market? What does it mean for the credit rating for the country? All those sorts of things start to come into play, and they'll probably be in play a little bit before May, to be fair. But those
Sure.
will be the questions that'll be plaguing us for the majority of the back half of 26.
Great context on that as well. I'd love to shift to talk a little bit about markets and sort of the overall resiliency that we've seen across many asset classes. Certainly, equity, fixed income, with spreads being tight and equities hovering around all-time highs.
Yeah.
And this, despite the fact that you've seen weakness, as you pointed out, in the labor market in the U.S.
Hmm.
So much so that the Fed has begun it sounds like, or projected to be a bit of a timid rate cutting cycle, but a rate cutting cycle nonetheless. and inflation still not within their target range. So how do you square sort of the market resiliency along with some of the economic headwinds that apparently are appearing?
Yeah, no, it's a great question, and Leslie, our CIO for equities, will say I think similar. Markets are not necessarily the economy, and the economy is not necessarily markets, and they are obviously very related things, but they are different things. I think we've been in a bit of a Goldilocks period here for a bit. U.S. growth has clearly remained quite strong despite the tariff and Liberation Day kind of wiggle from earlier this year, Q1 and into very early Q2. The economy continued to chug along, never count out the US consumer type thing. And, Q2 earnings were very, very strong on the equity side. And when you have an economy that is still chugging along at a pretty good clip and definitely off its peak and slowing, and you see a Fed that is becoming willing to ease into that and provide additional accommodation, even though I would say that it's debatable whether the rates in the US are accommodative per se, but they are providing accommodation by lowering rates or being open to lowering rates. And the market anticipating that, you can have an environment where, exactly what you said, you've got credit spreads at very tight levels. I mean, I think investment grade credit spreads a couple days ago at 47 were effectively where the Fed bought in early 2020 when it intervened at the beginning of the pandemic. I
Hmm.
mean, that's how
Right.
tight credit spreads are, at least on the investment grade side. Equities, as I'm sure everybody knows, close to all time highs, and there are reasons for that. Whether that's the earnings side or productivity growth or some stocks that clearly are perennially outperforming in the U.S. Um, I think all those things are driving. I think we're potentially at an inflection point here. And if the Fed, and this is why that one comment that I mentioned a few minutes ago, I think is really important. If the Fed is starting to think about today's cut as an insurance cut, as a risk management cut, institutional investors that want to add risk to their portfolios are not going to be particularly thrilled with that comment, right? That is not the let's keep the music playing type answer. That's a little bit more. We're getting a little bit later in the game. We're getting a little bit later in the party's almost over, and so people are going to start maybe taking some chips off the table. It's still early days, but and things can change and things will change, of course. But that's why I think markets when I say cross asset markets, I mean, whether it's fixed income equities, credit, or otherwise, so markets have I think generally been trading from that and from that perspective. We are starting to see a little bit more at the lower end of the income spectrum here in terms of some concerns, things like FICO scores declining the most in a few years, I think, since the pandemic. Things like real estate having some issues. Things like subprime auto loan lenders having financial issues. Things like some people or some parts of the income spectrum having some trouble with credit card payments. And you're starting to see a little bit more of that type of news, which is what you would expect when you expect to see a little bit more kind of concern over the economy going forward. But it is a bit of a bifurcated economy where those that are employed and are making relatively solid incomes are still spending, and I would say increasing spending. I think the Bank of America CFO was talking a few weeks ago, or maybe even a few days ago, and effectively saying that they're expecting or they're seeing maybe 3 or 4% increase in spending on their cards versus last year. And, so that's constructive, but at the same time you've got, I think, the lower end of the income spectrum is having a little bit more trouble keeping up. And that's not necessarily a new story. That's been around for a little bit, but I think it's starting to mature even more and becoming more of an issue here. And you see it in some of the employment numbers in terms of who within the employment spectrum is being laid off. And so there are signs there, and I think the Fed recognizes that, and the Fed wants to recalibrate rates, from that perspective. But with corporate earnings doing well, it has been a very constructive run here for obviously for credit and for equities.
Thanks for that. Why don't we turn to Canada? Bank of Canada did a 25 basis point cut as well today. I think that there was sort of less of a mixed story when we come to Canada, and there's been clear weakening in general. Love your reaction to the 25 basis point cut and what you think the future holds.
Yeah, I would absolutely agree with that. I think it's a little more one way directional in Canada than maybe in the U.S. BoC did cut earlier earlier this morning by 25. That was also very well priced. I think we went in around 23 basis points price for the meeting, so that seems relatively in line. There was no real discussion, unlike the Fed, around a 50. And in the press conference after the meeting, Governor Macklem actually did, I believe, suggest that they did discuss maybe not cutting rates this round, but they did. The reason I think the bank cut, and part of this is my own view, and part of this is really what the bank has also said in the immediate aftermath in the statement and the press conference, is that I think the bank's feeling a lot more comfortable around the inflation outlook. That's part one. The inflation outlook, I think, is particularly core inflation. The bank was concerned for a few months, maybe even a quarter or two, around core inflation remaining relatively sticky. And you saw in the press conference today, Governor Macklem speak about headline inflation, which is the Bank of Canada's target, and started talking about the headline inflation at 1.9%. And he mentioned that a number of times, and that seems to suggest that the bank is quite comfortable with where things are at. When you look at what the bank, this is not a forecast meeting for the bank. The next one in October will be the July meeting that was previous to today. What was, and when you look at the July forecast meeting with the monetary policy report, you can see in plain English that the bank does not expect the economy to come into equilibrium until 2027. And that to me has been a thing that I've been kind of concerned about for a while. Over the year, that's kind of migrated from 2026 to 2027. But one of the things that you and I have talked about a little bit on some of these podcasts is, the bank has a neutral range of 2.25 to 3.25% for its key rate, and sticking at 275, which it was before today's 25 basis point cut to 2.5, but sticking at 275 kind of in the middle of the range was really not a place where I thought that the bank should be waiting or perching, as I would say. And of course, should versus will is always the thing around central banks. But I believe that the economy was quite a bit weaker, and I was a little surprised that the bank stopped at 275 and didn't get closer to the bottom end of its neutral range of 225. And I think that the labor market degradation in Canada, which has clearly been more pronounced since the bank last cut, which was March of 2025, it has become the second big concern for the bank. So not only do we have maybe three things. So we've got core inflation the bank's not as concerned about. You've got an economy that's not coming back to equilibrium, so is in excess supply, as the bank would say, in terms of its output gap until not coming back until 2027. And you have a labor market that, with an unemployment rate here that's about around seven, above seven. Unemployment rate around, I think in Toronto is apparently around 9%. Um, I mean, these are significant numbers, and I think the bank sticking in the middle of its neutral range is probably not. The bank probably decided it was not an appropriate place. Never mind the risks that are coming up on the things I just mentioned, but obviously USMCA remains unclear, and then obviously the tariff story in the U.S., the reciprocal tariffs towards the US by Canada were clearly dropped by Prime Minister Carney in the last couple of weeks. And that dovetails back to the idea of, bank was concerned around core inflation remaining a little high and a little sticky. But with those reciprocal tariffs now presumably being off for a while, maybe permanently, hopefully, the bank has less concern around that. So I think that that's where things are at for the bank. And I think that the bank left the door open in line with my view that there's probably another cut to come. So I would expect back-to-back cuts from the bank. We had one today. I would expect another 25 at the October meeting, which would take rates down to at least the overnight rate down to 2.25, the bottom of the bank's so-called neutral range, and then we'll see what happens. My guess is that the balance of risks lie, given my outlook for the economy, the balance of risks lie towards additional cuts below 225 below the next 25 that is priced in. And the bank could go into what it would view as accommodative territory for rates for the country.
Great commentary on Canada. Why don't you take me through what you've done in the portfolio, given the views both in US and Canada?
There's been a lot. It's been a busy few months, for sure. The majority of the year, our key view has been we want to be long U.S. duration in the 10 and or 30-year space, and generally nominal duration as opposed to real duration or tips. So long fixed income. So looking for yields to move lower. And that has been a trade that we've had on a little bit just outright, but the majority of those trades have been spread trades. And the big one has been the Canada US narrowing trade, where we expect the gap between higher US yields and lower Canadian yields, particularly in the 10 and 30-year space, to narrow. And we've taken that trade effectively off for most of our portfolios in the last few weeks or so. And that trade had moved from, I think we got in around 140 basis points and it moved to around 85-ish basis points, 80, 85 basis points. And we've taken that off because we are a little bit concerned around continued follow through in nominal US duration lower in the long end. And we're less sure around long end Canadian yields moving higher here as we move into the next phase of the cycle. Although, if the bank does cut a little bit more than the market expects, maybe we could see a little bit of a steeper curve. But the budget, which the government has obviously announced here for November 4th in Canada, looms large. And I think that has the potential to be a significant driver. And unless you have an edge, or anyone has an edge, I have an edge on exactly what the budget is going to say. That's a tough one. And so generally, the prudent thing to do from a risk management perspective is, if you don't think you have an edge with an upcoming event, you start to mitigate some of the risks that you have in the portfolio and on the table. So we've done that a little bit on, maybe more than a little bit, on the U.S. Canada trade. We still have U.S. Germany spread narrowing trade on, but we like the German leg of that quite significantly. So even if we do see a little bit of upside on U.S. yields, we would expect German yields to move higher from a beta perspective, or said differently, we would expect Germany to underperform more than the U.S. On the FX side, we've done a little bit here and there. We continue to have our structurally weaker U.S. dollar story on, particularly against the euro and against the Australian dollar. We're relatively neutral on Canadian dollars here, which has been a good call because it's really bounced around really a three-figure range, call it 136 to 139 roughly in the round. We haven't really looked to make a lot of trades on either side there. But again, if the bank were to cut a little bit more than expected, then maybe the Canadian dollar can weaken. Although if the U.S. dollar is still if the U.S. dollar is counterbalancing that, then it's not necessarily a one way trade. To kind of stepping back a little bit, the general view around risk is, if U.S. and particularly I would say carry trades as a thematic and emerging markets, if U.S. rates are expected to be lower and the U.S. dollar is expected to be lower, it's generally a good environment for carry and risk, and that's been a thing that has obviously helped to drive markets here in the last few months. And kind of to your question before, the one you just asked, is that thematic going to change? Should we be continuing to hold as much emerging market risk as we do? And I think that's really the question of the next few weeks or months here. Can that Goldilocks environment continue? Yes or no, and why or why not? And how would one recalibrate one's portfolio as a result of that? There are clearly there's some rationale here for that thematic to maybe not be as in vogue as it has been for the last few months. This idea that some easing or some pricing from the Fed that we talked about earlier in the podcast, the market's pricing about 140 basis points, give or take, through the end of next year. If the Fed is not going to do that, then some of that needs to get priced out, and that means higher rates, and it probably means a higher U.S. dollar, and that's not particularly great for EM carry trades and for a general risk environment, unless earnings are absolutely crushing it. But if they are not, then then that global macro environment could change and that thematic could shift. So I think those are things that we're looking at, and we want to be kind of cognizant and aware of here as we move into the next part of the cycle for the back quarter, last quarter of the year, and into early 2026.
Well, thanks for walking through that, Dustin. Really appreciate the updates and your views on the central banks and broader economy. Appreciate it.
Very welcome. Thanks for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.